Welcome, market walkers. So in this video, I'm going to be showing you the oil trade that we are planning on doing on my end. So as you guys already know, there's a war going on, and for the past 2 weeks, Iran and the United States and oil prices have been consistently going up due to the blockage at Strait of Hormuz. Currently, as of now, this is March 11th. WTI is at approximately 95, and two oil tankers are set ablaze near its key export. I just want to do a quick analysis of how you can trade this and which instruments you can potentially more or less use in order to make a return on this. In no way am I supporting this war. In no way do I support innocent people getting killed. We just look at how we're going to trade this and how you can trade these events in the future. I'm just going to do a quick overview showing you how you can do it. So let's just get started. So WTI is at 95, as I mentioned earlier. What we realize here is that it will potentially push up to 100 again. It's last week it touched out approximately 120. So you can see it retest 100. So when oil reaches a threshold of 100, it is a perfect time to position for a sell trade. Now, I'm not saying you go all out and just don't care about the margin, but generally speaking, when oil is above 100, it's a nice sell trade and you'll make a decent return on the way back, approximately a year or 2 years at most. Usually it's less than that, 3 months tops. And knowing the circumstances that we have currently with a president that's big on drilling, you can see oil prices coming down because the president's vested interest is not to have a situation where oil is expensive. Okay, so if we look at a quick chart of why oil is going up, 20% of oil export goes through this Strait of Hormuz. And the primary countries that are involved here are China, India, South Korea, Japan, and then you can see Europe and United States aren't really effective, and that is the reason why United States is indifferent and is willing to go into this conflict. But China, India, and other Asian countries such as South Korea and Japan, this is approximately majority of their energy import region. So you're going to see the economies of China, India, and South Korea, Japan, along including with several other Asian countries, slow down. So what that means is economic activity goes down. So it's the perfect time for you to position yourself for a sell trade because this is not going to be good for the global economy. More or less, if you're also interested in investing in South Korean or Japanese stocks, this is the time to get into those markets because the Asian markets are going to be on sale. So, in a way, this is your time where you could get into these international markets if you have been staying away from it, especially South Korea. If you look at the return on South Korea, so the South Korean ETF that I usually look at is EW. If you look at 1 year returns, it's over 100%. So as you can see, it topped off. As soon as the war started, it came back down. So this is the time where you can position yourself for the South Korean ETFs and several other Asian countries, including Japan. And now, the Strait of Hormuz overall, if you look at the percentage, here's a quick overview. So crude oil imports from Strait of Hormuz for Philippines is over 90%. Japan is over 95%. Pakistan is over 92%. So overall, what you're seeing here is that these economies are tied to this region, and if they don't, if then they're essentially looking at an energy crisis the further this war goes along. So all of these major economies, especially China, including South Korea and Japan, their economies will slow down. What that means in the international market is you're going to see semiconductors being affected because Taiwan economic output is going to be down, and more or less, China would be affected because it has to. All these countries essentially have to conserve energy. So it's not in their vested interest to have this war more or less prolonged. As production is going to have to increase and oil prices will eventually have to come down, or some sort of peace deal would have to be shaped more or less to prevent this conflict from further escalating. So, how you can position for this is you can get into a double leverage one, and this is a more risk profile one. And you could rock this down and make a nice return on that. As you can see, 1 month is 72% yield in 1 month. So if you were to reverse this, let's just say you put a reverse trade from $100 all the way down, or 95, whatever the case may be, you can get at least 60 to 50%. You're getting 2x the return. And here's a quick chart of showing you this oil trade. As you can see here, in the last 20 years, there has been 910 days where oil has been above 100. That's approximately 18%. So if you do the inverse here, you're going to get a nice trade with a possibility of being 82% in your favor. So if you position yourself for a sell trade around the $100 mark, you're yielding approximately 35%. If you double this with a double leverage ETF, you're yielding 70% on the down. Now, if you don't want something that is high risk profile as double leverage ETFs are because they're adjusted every day, you can opt for United States Oil Fund. It's been up 38.47% in the last month. If you look at a 1 year chart, it would be coming down to around 69, 67 once tensions cool down. So this is more or less a 3 to 6 month trade that you hold off in order to see a nice return. And I promise you, it's going to yield better returns than the S&P 500 because oil cannot be at this price if you want the global economy to avoid a recession. So long-term positioning for this oil trade is the best, and it's going to yield you a high. There's a 99% chance you're going to end up making at least 30% this sell-off on oil eventually. So I thought I'd let you guys know. Don't panic. This is the time to sell this and hold it for a nice little sell in the long run. You'll make a decent profit. As always, thanks for watching, and I'll see you in the next one. The next video will be about artificial intelligence, just a heads up, and we're going to go through each of the supply chain and how the stack is set up for artificial intelligence. So stay tuned.